What's really interesting about Asia Pacific just generally is I think we're still seeing a very sort of buoyant market. And if we're looking at the volumes from the report that we've just published, particularly in Asia Pacific, we're pretty much seeing every real estate sector in terms of volumes of transactions is significantly higher than it was last year, or this time last year. So taking the office sector, which again, and I'm happy to go into more detail on this, which of course has had some additional challenges around returning to the office, and perhaps APAC's a little bit further behind on that. But we've already seen across the whole APAC region 8% higher volumes in terms of office transactions. But I think, where you say there's a huge demand for multifamily and logistics, we're seeing even the retail sector, 25% up volumes, logistics, 39%. And I think for Asia Pacific, the really interesting market, again, where we've just seen huge growth in terms of volumes over the last 12 months, is again back in the hotel sector, 68% up in terms of volumes. And I think that suggests probably a really strong recovery in that use class across the real estate asset classes.
Given the interest rate environment that we're seeing across the world, and perhaps not quite so emphasized here in Asia as it is in the US and Europe, perhaps, but we're still seeing raising rate expectations. What are the impact of that going to be, and how long and how hard will it hit?
Yeah, Tamer, I think you're right. I mean, Asia Pacific at the moment has been a relatively defensive market in terms of some of these rate rises, perhaps with the exception at the moment of obviously Australia's had a rise last month, and I think we anticipate another rise of sort of 15 to 40 basis points perhaps over the next 24, 48 hours. I think in terms of those regular Fed rates from the US, obviously the Bank of England following suit as well, we are seeing interest rates rising across the world. And of course, from a real estate perspective, that's having a real impact on property yields in terms of entry cap rates. And I think we're at the beginning of that cycle. And I think, we could be in for a period of perhaps 6 months of a slowdown whilst people readjust and reassess things. So particularly for the stronger outbound investors from Asia Pacific, so particularly from South Korea, Japan, Singapore, Hong Kong, I think we're going to see some caution around some of those rates when they're investing in markets like the US, like the UK, and across Europe. And I think across the board, I mean, certainly in the US, where there's a little bit more evidence, we're beginning to see cap rates, depending on the market and the sector, move out anywhere between 25 and 50 basis points. We're beginning to see that in major European markets as well, particularly in the office sector like Germany, where cap rates have just been so compressed for such a long time now that any sort of minor impact on interest rates is going to start to impact those yields. I think we can take some comfort there, particularly in Asia Pacific, where just the sheer weight of capital looking to be deployed into real estate is going to counter some of those headwinds we're currently facing.